Hello again. In this episode, we're going to talk about what types of income are taxed versus not taxed. This is a game changer for many people because it can dramatically increase your net spendable retirement income. So I'm going to empower you with a greater vision, overcome some obstacles that most people have, and create a transformation. And I'm going to give you the specific action steps that you can take to transfer a lot of your income, especially later in life during retirement, from taxed income to tax-free income. I'm Doug Andrew, and I've helped many people prepare for a more secure retirement for over 45 years. In fact, the last 15 years or so, I've been more interested in becoming a consumer advocate to help people like you. I let all of my professional licenses automatically expire the last business day of 2005. I started a national radio show and I started writing more and more books. I've written 11. My goal is to write one book every year, the rest of my life, to empower people like you to understand some basic strategies that can dramatically enhance not just your net worth, but your net spendable retirement income. I prefer to use my own private retirement planning methods rather than the government's retirement plans like IRAs and 401ks because they are so much better. So let's first of all review, if you've watched other episodes, the three types of income that we pay income tax on. This is in the United States. It's been this way since 1986 tax reform. And ever since then, Americans only pay income tax on three types of income: earned, passive, and portfolio income. Your earned income is your salaries and wages, and passive income might be rental income or lease income. And portfolio income is where most IRAs and 401ks generate cash flow during retirement. That would be interest or dividends that you're earning on your investments. All three of these appear on the front of your 1040 tax return. There's no way around it. They are subject to tax, even those IRAs or 401ks. I'm still alarmed by how many Americans say, "What? I have to pay tax on my IRAs or 401ks when I retire?" Yeah. What part of tax deferred didn't you understand? You're postponing or procrastinating paying the tax. Well, I've learned in 45 years of helping people to minimize taxes and empower or give them additional income how to use sections of the Internal Revenue Code that have been around for over 100 years that grandfather people to have tax-free income. And it's so powerful, I've actually named this vehicle the Laser Fund. Laser means liquid assets safely earning returns. There's just a handful of vehicles that let you earn tax-free rates of return when you go to access your money. You might think I'm talking about a Roth. A Roth is okay. You take after-tax money and it grows tax-free and you can take it out tax-free. But I've earned rates of return greater than most Roths average, but I have three additional benefits in my Laser Fund that Roths do not have. Municipal bonds are tax-free, but I've always earned 2 or 3% higher rates of return in my Laser Fund than most municipal bonds, and I feel like the Laser Fund is far safer than most municipal bonds that are offered by some cities or counties that maybe aren't running in the black like they should. So I'm going to share with you three sections of the Internal Revenue Code that I even teach CPAs and tax attorneys, and they go, "Oh, I've heard about these, but I never understood them before." So in order to enjoy income that is not deemed earned, passive, or portfolio income, you need to do a strategic transfer, a conversion of your money. And this cannot be done overnight. It usually takes a minimum of 4 years and 1 day in order to transfer and have tax-free income forever after, because you have to jump through certain IRS hoops, so to speak, in order to do that. So in my various educational books that I've written, I talk about three sections of the Internal Revenue Code that actually have been sacred cows since before the code. But in the current code, it's sections 72E, 7702 and 101A. Basically, 72E says that any money that you accumulate inside of an insurance contract. Now, what's the best insurance contract? I prefer a life insurance contract. But before you judge that, this is an insurance contract that is structured with the least amount of insurance the IRS will let you get away with. That's dictated under these tax citations, TEFRA and DEFRA. They actually stand for the Tax Equity and Fiscal Responsibility Act of 1982 and the Deficit Reduction Act of 1984. And this is the Technical and Miscellaneous Revenue Act of 1988. Sounds like a lot of complexity, right? Well, when you learn these, and I teach these to sophisticated tax attorneys and CPAs, and they go, I've heard about those. I never understood them clearer than you just made them. With these tax citations, you can accumulate money totally tax-free like I have for over 45 years, where if I earn 11% in my insurance contract, yes, I earn 11%. There's been years like 2017, I earned 25%. Other years I've made 16%. Some years when the market dives, I don't make anything, but I don't lose because I use indexing. That's a strategy. I'm not talking about index funds, but I can earn my growth tax-free under Section 72E as long as it stays under the definition of a tax-free insurance contract. Why is it tax-free? Because for more than a century, it's been a sacred cow. Because if I'm taking ownership for my future, that if I die sooner, my widow, my orphans will not be relying on the government. And so why would they tax an instrument like a life insurance contract that blossoms and transfers? It auto-transfer tax-free so that they don't have to be a drain on society. But if you're using it, if you live a long time for income, the income can be tax-free also because you're taking pressure off of the government providing help with more benefits, welfare, or even Social Security benefits. You're taking ownership instead of relying on the government. So they give you tax incentives. So it allows you to access your money tax-free under Section 7702. And that's all your gain into perpetuity. I've had people who have retired at age 35. And they have had tax-free income. Every $1 million they have in their laser fund accumulates tax-free, but it'll generate $100,000 a year of tax-free income if they live to be 100, 120. It knocks the socks off of a traditional IRA or 401k that is only tax deferred. But at the end of the day, when you finally do pass away, it blossoms in value. It increases. Many times it doubles or triples. If I died right now, every $1 million would increase to $2.5 million and transfer tax-free under Section 101A of the Internal Revenue Code. Now, those three sections have been around for over 100 years. It's a sacred cow. And so in the various educational sessions that I teach and in the books that I write, I eliminate the dangers of taxes, inflation, market volatility, and economic uncertainty. That spells the acronym TIME. And I do that by showing people how to convert to tax-free vehicles, link your returns to the things that inflate, and then use indexing so that when the economy, the market goes down, you don't lose, but when the market goes up, you make money. You need to watch that episode to see that, and you're gonna have this big aha epiphany like most tax attorneys do. But the greatest strengths of these laser strategies are liquidity, safety, and predictable rates of return. Liquidity is the ability to access your money when you need it. And I'm talking about with an electronic funds transfer or a phone call. I want to be able to access money when I need it. Number two, I want safety, not just safety of the institution, but safety of principle. Whatever I set aside, I don't want to lose. But in a year, I make money, that becomes newly protected principal. I don't want to ever lose in the future the money I made in the past. Do you know most advisors have no clue how to do that? So that's what I mean by safety of principal. And number three is to earn predictable rates of return that historically have beaten inflation because you're linking your returns to the things that inflate. And it's usually earned a rate of return of 5% or more greater than the inflation rate, but it's earning a rate of return that can keep ahead of the cost of living increase so that you don't outlive your money. So the question I get asked all the time is, well, is a Roth IRA 401k the best way to go? Actually, the laser fund will outperform a Roth. It has three benefits that Roth will never have. I can throw in huge amounts, 100, 200, 300,000 if I have a banner year. I don't have to put in any money if I don't want. If 4 days later I need to access 94% of my money, I can do so with an electronic funds transfer or a phone call. You can't do that with a Roth, but a Roth will not increase in value when you die. So in the various books that I've written, the Laser Fund, when you click on this video, this episode, I would strongly recommend you watch that, and then you'll see how you can get a free copy of this book. Just pay a nominal fee for shipping and handling. And you'll learn how the Laser Fund will allow you to access money the sad way, the dumb way, and the smart way. Now, the sad way is by dying. It's one heck of a return, but I wouldn't recommend that one. But see, I don't worry. If I happen to pass away, my wife, my family will be endowed with millions of dollars of tax-free cash because it transfers tax-free. I want to live a long time, but if I don't, it's blessed many families when people pass away. Now, the dumb way to pull out money is to trigger unnecessary tax. The Laser Fund is grandfathered in the Internal Revenue Code to allow you to withdraw your basis. It's called a recovery of basis. If I put in 500,000 and it doubles to $1 million, and the million doubles to 2, and 2 million doubles to 4, and 4 million doubles to 8, many of our clients have done that. And they have 8 million. The first $500,000 they pull out is tax-free because you recover your basis first. Most investments, you have to start paying tax immediately, like IRAs and 401ks. But the smart way to access your money is simply to leave it there earning interest, and you withdraw or you borrow the equivalent of your interest. Borrow your own money? Yep. I become my own banker. I borrow money out at sometimes a cost of 2%, and they credit me the same rate. It's not costing me anything, but borrowing money out of my insurance contract is tax-free. It's been that way forever. If I borrow at 5% and I keep earning 10%, do you know some of our clients in 2017 borrowed money at 5% out of their laser funds and they earned 25%? Hello? They made 250 grand and the insurance institution only charged them 50,000. They made $200,000 on their money while they were using their money for something else. If you want to know how to do that, watch this episode and then get your free copy of the Laser Fund, and you'll read all kinds of stories and examples on how to empower yourself.